Alrighty. It is the top of the hour, and that means it is time to begin this month's installment of the State of the Firm call at Phillips Financial Strategies. So here's what we've got today. We've got a bit of a special treat with a 401k enrollment. Normally we have a guest speaker for these things, but we do from time to time need to conduct a little bit of 401k education information for our various group plans that we administer here at the office. And so that's really the focus of today's call. But for those of us still working, for those of us who haven't retired or found the joy of, being independently wealthy yet, frankly, what we've got to do is we've got to keep working. And so we make contributions to our 401k plans, our 403b plans, various other qualified plans. And that's what today's call is all about. It's all about, do I put money in that traditional pre-tax 401k option, or do I put money in that Roth option? Does it matter? Does it not matter? Where does that money go? We're going to try and answer some of that stuff today. And we're going to talk about strategies if you don't make a whole ton of money and you're young, or if you're making a good bit of money and you're, say, middle-aged. And what happens if you're a lot closer to retirement, like in your late 50s, and you're thinking about, hey, did I put enough money in all the right buckets? What do I do? So that's going to be the thrust of our conversation for today. Before that, we've got a little bit of housekeeping. So your screens are muted, your video's off, your mics are muted. That's the usual stuff because we put this up on YouTube. So we want to make sure that folks can't just break in and just interrupt with commentary. So that way we have a nice clean recording. If you've got questions, email us in. If they're ready to go, something not too personal, we'll try and cover it on the call during the Q&A at the end of the presentation portion. If it's a little bit more personal, a little bit more directed towards your situation, what we'll do is we'll answer it for you offline and make sure that we get in touch with you. If you've got if it sparks a larger thought process and you want to have a full meeting around it, absolutely shoot in an email. Lauren, Mariah, Charles, myself, somebody will get in touch with you. We'll get a meeting on the books and take some time and dive into it. So that's the rules of the road. Next, we're going to talk about housekeeping. So we're coming into that end of year. We're about to start the fourth quarter. So there's a couple of things that are going to happen because it's September. First item is the Washington, D.C. Reader's Choice poll that we love to do every year. We sent out a bunch of emails about it. We put some stuff on the Facey Space page and the Instagrams and MySpace and LinkedIn and Twitter and all those kinds of places. Please, if you like us, go vote for us. We also welcome your feedback. So your feedback helps us to do a better job. We're here and we want to be here. End of the day. And it's your feedback that gets us from here to here. So we're doing the best job possible. So that's the housekeeping. Also, we're sliding into fourth quarter. So we're talking about things like making sure if you are of an age or you have accounts where we have to do required minimum distributions, we want to make sure that you get in touch with us early to get out any possible charitable distributions, get money in your bank account in time for maybe spending some money on the holidays for grandkids or whomever, making contributions to 529 plans, all those things. We want to get that stuff wrapped up early this year. So that way, by the time Thanksgiving rolls around, no one's jumping around like a jackrabbit to make sure that money's gone to your account, money's gone to wherever it needs to go. And also, and I will say this because frankly, we get a lot of requests every year from clients, various things. Either you guys missed the NPR fall giving campaign and you want to get your tote bag, you want us to help get some money over, or it gets to be late in the year and you heard the advert on NPR about donating gifts of charitable stock. We want to get that stuff in and get it done early. So that's the housekeeping you get. Make sure to keep an eye out and your ears peeled for emails and phone calls from myself and the team as we do some of that stuff. It's also before the quarter closes, so there'll be an email that comes around in a couple of weeks regarding the quarterly meetings for folks that we do meet with on a quarterly basis, whether portfolio rebalancing, etc. That's the housekeeping. Next, let's dive into portfolios. So we just wrapped up kind of a big bulk of earnings season in the last few weeks. Stocks have been kind of gyrating around for those of you with individual equities in your portfolios. We have seen some rollover in recent weeks. I'm going to address all three of those things as well as some fixed income. So that'd be the bond portion of the portfolio. So Barclays aggregate bond, high yield, floating rate, all those kinds of things. So let's dive into that real quick, and then we'll dive into the meat of the conversation. So item one, let's talk stocks. So it's earnings season. That always creates a lot of volatility, makes portfolios move around quite a bit. We have seen a couple of stocks drop in terms of pricing. It represents kind of buying opportunities. We're reducing out a couple of the positions. Thankfully, we haven't really had anything where someone's come out with particularly bad news or major change in focus that has affected the portfolios. Part of that is our overall investment philosophy of seeking out sound management. So these are folks with good pedigrees and track records, as well as companies with what are referred to as strong economic positions. So good profitability, strong balance sheets. We think about that from a financial planning perspective, realistically, which means, do they have a lot of debt on the books? Are they making good money? Like from cash flow perspective, do they make and bring in more money than they spend? Those are the kinds of things that we want to keep an eye on. If they're spending a bit more money than they're bringing in, why are they doing it? Is their revenue growing? Is there a disproportion? Is there an opportunity there? And so we start looking at those kinds of things in depth. But that's why we kind of largely haven't been affected. We have had a couple of stocks also jump up in price pretty dramatically. You'll notice in some rebalancing that we'll be selling some of those off. I continue to maintain the philosophy that no one went broke by selling for a profit. So for that, we are going to take some gains. It doesn't hurt anyone. We don't want to get over allocated or overextended because, as we know, sometimes what must go up must come down, and we don't want to be on the wrong side of that. So we'll be preserving some of that. We'll be further continuing to diversify the portfolio. That's the individual equity side. Markets rollover. September historically is not the greatest of months in terms of market performance. It is more often than not a down month. And you're probably thinking to yourself, well, William, why didn't you sell everything and just wait? The reality is, I said, more often than not always. Also, we don't know the trajectory. So we don't know if we start off the month by going up, say, 7 or 8% and then coming down 5. If you do the math on that, by the way, that still means you're up 3. And so that's why we don't sell off and go away. The other thing is that some of these things are sometimes sector-based, which means that maybe like technology sells off and is negative for the month, but commodities and retail maybe are up. So we don't want to be on the wrong side of that, and that's why we don't just sell everything and go away, because you can't really time the market in that way. It's never consistent. What one of my old professors used to say many years ago is that the markets are predictably irrational, and the thing that you can count on is their irrationality. That being said, let's move into bonds. Bonds are oftentimes referred to by economists and various folks in the finance world as the adults in the room. So what we've seen is interest rates rise a little bit. That's perfectly fine. It's all well and normal. And no need to panic, by the way. I do want to point out that this is not the February interest rate wreck that we saw where interest rates moved pretty dramatically. We haven't seen that yet. But you also have to realize from a historic perspective, interest rates are still really at historic lows. And so we do expect some measure of reversion. That means things go back to where they're supposed to be. That's going to happen. And so be patient. Keep an eye on it from a fixed income perspective. We are keeping an eye on it. We maintain the position that now is the time, with interest rates where they are, equity prices where they are, and various diversified portfolios, indexes, etc., being where they are price-wise, and certain things being of value in the market, certain things being at a premium. We maintain the position that now is a time that is better than ever for diversification. I know I keep saying it, I'm a broken record, but diversify, diversify, diversify. And then when you're done, diversify some more. Because that way you can't get caught offsides, but you focus on quality, you focus on diversification, and that ultimately will yield to better investing. Speculation sometimes works, sometimes not. Growth sometimes works, sometimes not. Value sometimes works, sometimes not. The reality is that you want to have a little bit of all the things, and you want it to be measured appropriately to your risk tolerance. That being said, let's dive into our presentation for the day. So this presentation is one that has, I would like to say, is a common conversation throughout the course of my career. And it's a active debate when the planners get together and, you know, before COVID, we, get together and there'd be drinks after the CE classes and all the other stuff. This would be one of those hotly debated things. Does it matter, Roth versus traditional? What's the real benefit? Where are we in the tax scheme? Yes, this is the kind of stuff finance guys talk about, and finance ladies as well. So the easy answer is examine the variables and determine what's right for your situation. So recently with the Tax Cuts and Jobs Act, one of the things that they actually got right, that was a major change in our tax code. Whether it's unintended consequence or not, I'm not getting into the politics of it. I'm talking specifically about savers and people investing. Is your tax bracket is now indexed with inflation, which means that each year we expect, if you make $62,000, $65,000, $100,000, $200,000, we expect that if you get that 3% raise, that you're going to stay at roughly the same effective tax bracket. Because we're going to expect the same tax brackets, the same things that govern that calculation, to increase with cost of living, which is really good if you're a saver and you've been putting money in that traditional side. Keep in mind, prior to that, we weren't indexing with inflation the same way. There were periodic adjustments that the IRS would make after they realized that things were out of balance. That's the extent of it. And so what we want to focus on first with this little math calculation about pre-tax versus post-tax is we've got time. It's a time value money calculation. For those of you who sat through economics, I'm bringing this back. So sorry. We got time, we got rate of return, we got compounding, and that's what we got. We got the number of periods, that's time. We got interest rate, compounding. So let's dive into the factors here. So what I've done is I have put together a hypothetical couple, and I've modified their ages, I've modified some savings rates, and I've modified some income in order to be reflective of some various folks in our client base at the office. So these figures are not representative directly of a specific client, but you may find some parallels as you watch the video and you watch some of the things that we have. And so what we've got really is we've got a nice couple. We've got a scenario where I have them at, say, 26 years of age, each making about $62,000 a year, just kind of starting out. Maybe they had that, maybe they each met and fell in love, one of those happy hours after being on the hill, and now they're together as a couple and trying to do a little bit of planning to determine how they should save. And as they've moved on from being, say, interns on the hill, or gotten that promotion up, before they get the promotion to legislative director, that kind of thing. Next, we've also got some 33-year-olds in a couple of different scenarios. So we've got some legal folks doing quite well for themselves, making about 150 a year, and we've got some folks making a bit less, around 100. We use 100 as a baseline because about $100,000 a year is sort of an average salary cost of living area for the DC metropolitan area. And so I wanted it to be somewhat reflective and applicable to the larger group of folks this is targeted towards. We also, and I will touch on some higher income earners and some older folks. So we've got 26, 33, 39, and 45 in terms of ages that we're going to work with in the scenario. and roughly incomes that range from 62 for the 26-year-olds all the way up to 150 for a 33-year-old. We've got 100, and we've got a couple of scenarios here. And so the gist of it is, because I don't want to bury the lead, the gist of it is that because of that 2017 Tax Cuts and Jobs Act, what you're going to find is that the difference between the two is a largely de minimis. What you will find is that in your specific scenario, depending on what you're making, depending on what your age is, and some of the stuff that we talk about will help to modify your decision about where you should divide up and diversify the assets. Because it's not just about, by the way, diversifying the asset classes, it's also about diversifying your tax base. And so we want to make sure that we've got money that is, we've already paid the taxes on it in the Roth bucket. We want to make sure we've got money in that pre-tax bucket. And we also want to make sure that we've got money in this sort of like taxable, non-qualified, nice and liquid bucket. Because they're all going to get a different tax treatment. They're all going to grow in different ways. So without further ado, let's dive in to the team. I'm going to turn on the screen share here, and we're going to start taking a look. So let's hear who's up first. The youngsters are up first. So here's what we've got. We've got a couple. They are age 26. We've got Alex and Kelly. And what we show here is we show a pair of retirements. We show their savings, and we show their ARC and their cash flow. Now, we track them from a cash flow perspective from age 26 all the way to age 95. And they're just starting out, and we're saying, who's putting money, one second, who's putting money where? And more importantly, their present living expenses are $60,000. So between the two of them, each making about $62,000 a year. Presently spending the bulk of that, which is pretty common, and spend what you make. And then in the retirement, what we've done is we want to give them a little bit of a raise in terms of adjustment, because right now they don't have a lot of money to set aside each month. They'd like to have a little bit more flexibility. In terms of net cash flow, you'll notice we've got a couple of years where we've got some negative cash flow because we've got some kind of big expenses that pop up. But overall, the balance sheet looks nice. We've got the money that they make. It grows with inflation around 4%. Their expenses grow with inflation. It matches up. They're saving money. Right now, they're putting about 7% into either the pre-tax 401k investments or 7% into the Roth investments. Now, an important thing to note here as we look at this is that when you have what's called a safe harbor 401k plan, so those employer matches that you're getting, those are actually going into a separate pre-tax account. So you've only got 7% going into the Roth on that 401k, and then whatever your employer match is, that's going into a pre-tax account. That's really important. So even when they're on the Roth side, they're still generating some of those pre-tax assets. And so what we see is that they save money, they work all their lives, they do all the things diligently. And because of inflation, we're now all the way down here to retirement time. And so now we start looking at stuff. And so what we can see here is that on the pre-tax side, they've got about 4.6 million. And they've got less money on the Roth side, ironically. I wonder why that is. Well, what we know is that they've got to pay taxes. So some additional money here and there is going to leak out the door in terms of what they can spend, because they won't always be able to adjust all of their savings because they can't go negative in their budget, which we'll see. So what we see here is that they've got a little bit less money on that Roth side. But what happens is that as we progress through the spending side, what we see is that as the income creeps up, and we see some of the other stuff, we see that they need to pull out, from a buying power perspective, less money because they're paying less taxes. And so ultimately what happens is that you come all the way down here to age 95, and we say, okay, well, they've had children along the way, they'd like to leave some money. What's the value of their investment estate? So what we see on the pre-tax side, because they're pulling more money out to maintain the same lifestyle, we see that their total assets that they pass along to heirs for their legacy is actually smaller than we see for the Roth. So that's 407 compared to 684. And what I've done, by the way, with these documents, which we can certainly make available on request and walk through on an individual basis for these sample clients, is we can go through sort of the specific ins and outs and the details. But what you need to know basically is that we've got age 26, we've kept all of the investment portfolio performance the same, and in this case, we've got 7% of salary contributions. So that's the key stuff. Next, we're going to move on to another group, and I'm going to show you how it changes a little bit with time. And I'm going to give you what it tells us here in a quick second. So we're going to switch and fast forward. Let's talk about this same couple. Let's say they're, instead of having to make this decision at 26, they're making this decision at 33. Maybe they spent some time in grad school, whatever else. Now we're at this juncture point in terms of their savings and their scenario. What we see, by the way, in terms of these arcs, is that we've got fairly significant. We see a $90,000 a year in expenses versus the 80 that we were looking at. We see retirement in terms of $95,000. By the way, these amounts here that we're looking at, these are in today's dollars. So we'll use today's dollars and we'll project that forward up to age 33. So here's what we see. We start looking at the tail of the tape, and I'll run through these pretty quick. Pre-tax investments, same kind of situation, Roth. Now, this is interesting because I have built in some taxable investments and some other stuff. What we see in the scenario with the Roth is that, and this is be valuable for later for comments, is that we start to see this situation where their spending is actually negative and they're not actually able to maintain their lifestyle on the Roth. And that is from the taxable side and the amount of money that they're putting in. So they're actually, from earlier savings that are liquid, they're actually subsidizing their lifestyle a little bit. The end result that we see as we come down through here, same principles hold true. Roth, you have less taxes, so you're pulling less money out. But what we see at the end of the day is that because of those initial having to make ends meet earlier, what we're seeing here for these folks and the way the tax bracket works, remember I mentioned earlier about that indexing and some of the stuff, what we're seeing here is that now we actually have more money on the pre-tax side than we do on the post-tax side. So pre-tax is a better choice than Roth. And like I said, each of these situations, we want to custom tailor to your situation to determine what is going to provide the most value at the end of the day. Next on our list here. All right. This was actually particularly interesting. I thought, hypothesis was, if we increased the income, that what would happen is that we would see more parity between pre-tax and post-tax. But what we actually saw, again, because of that inflation rate, is that what we saw was we saw some measure of sacrifice. One moment, please. What we saw is some measure of that sacrifice of earlier investments ultimately playing out and showing us one very important thing. The discrepancy actually gets larger when your income tax bracket gets better, because what we're seeing is we're seeing that these folks in this higher income tax bracket are staying in the same income tax bracket, even though they're giving themselves a little bit of a raise. And that is really important to keep in mind in terms of how the situation matches up with your personal situation and where you put money. Now, a quick caveat to you higher income earners. And I didn't illustrate this because it is not a common item that we see on all 401k plans, but it is available on a number of 401k plans. what you have are what are referred to as non-Roth IRA, as non-Roth 401k contributions. And so what that means is it means that what you can do is you can max out your 401k pre-tax contributions. You can then continue to make what are called non-Roth after-tax contributions to that same 401k plan in the amount of all the way up to about $55,000 if you're on, even if you're under 50. You can then turn around, because remember, you didn't take a tax deduction on that money. You can then turn around on that money and perform a Roth conversion if you have the Roth 401k capability within your 401k plan. And you can now get that benefit of that Roth contribution. Now, that illustrates very differently. So if you're in that higher level tax bracket and we see that you've got some cash flow in your overall financial plan, and we have that flexibility within your 401k plan, there's a possibility that this could increase your savings rate dramatically, but more importantly, this helps to close certain gaps inside of your ability to save for retirement. Now, one other item that I did not mention as we progressed away from the 26-year-olds that were a bit more wealthy, we did bump up the savings rate to 12% because what we're looking for in terms of an overall savings rate and an ideal situation, what we did find is that, and this is the sort of more ideal scenario, the more ideal scenario is that you want to get to 20% of your gross income. And how do we get to 20% of our gross income? We've got money that we contribute to our 401k plans and our 403b plans. We've got maybe some employer match. The other thing that we've got is we've got some Social Security. And so we'll work backwards from 20%. We'll call it 6% from Social Security. You know, those benefits are going to get reduced for some of us younger folks. And then, though I'm starting to not be that younger folk. And then we've got maybe some employer match, let's say 3 to 4%. That's, you know, gives us around 9. And we've got to come up with that number. So 11, 12%. So between 10 and 12% really is kind of that ideal figure that we want to be putting into the 401k. 6% is too little. If you're a high income earner and you're capped at 19.5, which is the number this year, you know, 19,500 may not get you to 12% of your income. It may only be more like 7 or 8. So this is how we get you up to that 12%. And so this is one of the many options. Next on our list here, let's talk about age 39. This becomes interesting. So let's say you're age 39, you're kind of in that same sort of boat. We start looking at stuff. What we found is that from an adverse selection arc, what we saw is that 39-year-old, same boat, keeping all the factors the same, changing only age. What we saw was that actually Roth catches back up and matches out. No, it's not a mathematical trick. I checked it multiple times. We changed a number of things. The reality is that what we see is that based on timing, size of the account, and that 4% inflation adjustment piece, we see where that takes hold and it modifies the situation. And basically, remember I mentioned that 2017 Tax Cuts and Jobs Act, that comes into play here with that whole inflationary pressure and why you want to have tax diversification. Next, we're going to jump up here a little bit. Let's talk about that age 45. Real quick, plain to see right here, what we can see is that starting later, the need, even the need for portfolio, we see that keeping all factors the same, just jumping up to age 45, they've got a little bit less money that they're starting out with. Maybe they weren't big savers early. That's why they kind of run out of money here, because I didn't change anything else but their ages from prior allocations. What we see is that on the pre-tax side, their money only lasts to age 86. But on the Roth side, again, remember what I mentioned, they've already paid taxes on that money. We're seeing money last until age 88. So there is a little bit of an arc that determines ideally where you should invest in terms of pre-tax versus Roth, and your age and time. I've also cross-tested this with a couple other things regarding moving investment return. Compounding, I will say this, compounding in these scenarios as I tested it plays a major role. And so if you're not a client of ours and you've got your own financial advisor, or you're just a 401k participant and you're not working with us directly with financial planning, we recommend that you reach out to somebody. You run one, you have a CFP, someone of that caliber, you have one of these kinds of financial planning scenarios put together. If you're working with us, we've already got this data, and you want to get an idea about what really is best for you, let's work together. Let's take a look at this scenario and see what works best for your situation. Now, one of the things that I am going to also give you is I'm going to give you a couple of caveats, because I've generated all of this data, and we've got the follow-up notes down here on each of these documents that I've presented. We've got the follow-up data. It's all based on what the current tax situation is, and based on assumptions related to the way their earnings growth might occur. You might be in a situation where your earnings growth is highly fluctuating because you're a business owner, or you are going to sell your business, or we've got some various other caveats to the way your income grows that might cause it to grow at a non-normal rate. Or, for example, let's say you're one of our many servicemen and women. We know on average they get a 1 to 2% raise instead of a 4 to 6% raise, which you might see in the private sector. All of those things are going to affect how well this scenario functions and what plays out. I did a lot of testing on this before resolving to just present these to you all. And the simple fact is that what we found is that this is pretty representative of the population. You definitely want to get something that's more personalized to you and not just to use this, but some of these scenarios that are presented should speak to you a little bit. They should be at least somewhat relatable and representative of your situation. The other point that I will make is that taxes historically are at all-time lows. We expect that figure, I mentioned reversion earlier this year, or earlier on our call. We expect that to change. So I would expect from now to the rest of the course of my lifetime, taxes to go up on average. We may see a tax change in some areas that may directly affect you. We can't always plan around it, but going back to what I said at the beginning, diversification, diversification, diversification. You want to have different assets taxed differently, different pools, because let's say we stop indexing our incomes. All of a sudden, now that those Roth contributions are going to be substantially more valuable, because what we see from these scenarios is that over time, if you're all on the pre-tax side, you've got to draw more and more money out. And if we don't keep indexing, what happens is that when you're at age 75, you're going to be in one tax bracket. And when you're age 88, you're going to be in a completely different tax bracket. Right now, you stay in that same tax bracket. In the old days, you change tax brackets. So we want to keep a handle on these things. That's where prudent financial planning comes in. That's where prudent, regular analysis of these kinds of things will come into play over the course of your lifetime. It's not maybe necessary to deal with it on a quarter-by-quarter basis, but from a forecasting perspective, statistician standpoint, things will change dramatically from age 65 to age 90 in your lifetime. And even more so if you are age 50 and we are forecasting what is going to happen when you are age 80. So with that, I'm going to end the share, and I'm going to open the floor up to some questions, and I'm going to check the inbox, see what we've got. 1 second more. Checking the inbox, running a quick update. Going once, going twice. I do not see any emails. Folks can in fact raise their hand. So if we've got any questions that we want to have answered, if anybody wants to raise their hand, they can. Otherwise, what I'm going to go ahead and do is I'm going to let everybody go. So going once, going twice, 3 times. All right, ladies and gentlemen, greatly appreciate you all tuning in today. I hope that was at least some useful information and gave you all a good foothold, something relatable, something actionable. If you like us, vote for us. If you liked this, share it with your friends, share the information. The biggest compliment we have is not being kept a secret. And with that, it's time to end. We'll see everybody next month. And I wish everybody a wonderful and superb September. All right, bye-bye, everybody.